Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. The last podcast we did were Mark's 2019 predictions. And before we really jump into some other content today, Mark received an absolutely amazing, some would say prophetic email from somebody who seemed to want to be a hater, for lack of a better description. But after he reads this email, which is how we're going to begin the podcast, you're going to see, for those of you who've been listening to this Invest with Clarity podcast for a long time, that this guy is really just reinforcing some stuff. So, Mark, why don't we start off with you reading the email, and then let's break it down.
Sure. So I got the email this past Sunday, and the email was titled "Serious Blah Blah." And I'm like, well, that's interesting. When I opened that up, and it came from someone I didn't know, and so I opened, I just looked at it and read it, and it said, these quote predictions are simply various market activity at work on any day the market is open. These are not unique predictions, ... Rather, your partial list is market expected and known behaviors. By the way, if you want to read those predictions, you can go to our blog site at investingwithclarity.com. You can also go to our main site, investwithclarity.com, and click on the blogs, and you'll see it there as well. He then says, you have offered good statements regarding market behaviors at work every day. Your top 10 are investment tenets. He says your top 10 are investment tenets are taught in Investments 101. They are correct, but hardly a prediction. You list a basis of knowledge required for most investors. To hold this out as new knowledge, by the way, I didn't remember saying that was new knowledge. Did you ever hear me say it was new knowledge?
No, I do not remember you saying that. That's okay.
I just said that we're 7 for 7 in the years that we've done this, and we'll be 8 for 8 or 9 for 9, whatever how many years it is. We've been right on every prediction. To hold this out as a new knowledge that gives you a top 10 year after year investment prowess is wrong. These are investment tenets. That's all. You can do better than this. So I thought it would be important to respond to him. I thought it was very nice of him to share with me his thoughts and reiterate the power of clarity. So I said good morning to the individual. First, thank you for sending me your thoughts. Second, I could not agree with you more regarding Investing 101 and sticking to the basics. That said, statistics show investors do not stick to the basics. Instead, they do exactly what I put in my predictions. The definition of a tenet is, quote, a principle or belief. While that certainly is the case with the predictions, the definition of a prediction is, quote, a statement of what will or might happen in the future. Thank you for making the case for, quote, Nepsis, i.e. clarity. Have a great day. Mark.
So why is everything that he said there support what you have been saying, not only on this podcast, but the radio show and the blogs? Unpack it just a little bit before we get to your next topic, please.
Yeah, well, the theory is that investors really don't know what they own and why they own it, and they become emotionally attached to the investments and to volatility in the market. And as we've said over and over again, volatility creates opportunity, which we're going to talk specifically about in the next segment here. But the fact of the matter is that what I put in here are things that happen, but the reality is the behavior of the investor is consistent year in and year out. And that's my prediction. Investors will continue to act out these 10 predictions unless they find themselves what we call clarity. Clarity in their investments, clarity in their planning, understanding what they own and why they own it.
Well, let's take a move. I mean, if you have been wondering what volatility looks like because you've been asleep for the last 10 years, because really there hasn't been volatility. So let's go talk about what's going on.
Well, okay. So as we in the top 10 predictions, the second one on the list is company stock prices as well as the quote stock market. Remember, Matt, we tell our investors every day, you don't invest in the stock market. The stock market is a market where you buy and sell goods and services. There's the flea market, right? There's the vegetable market. There is the stock market where you buy and sell securities. So the company stock price as well, the stock market will move up and down irrationally as usual. Remember, you don't invest in the market, invest in businesses purchased through a market. Volatility, which certainly in the fourth quarter of 2018 probably scared a bunch of people as we saw the largest pullback from peak to trough since the financial crisis, 20%, will get people thinking. It will get them wondering, what is happening with my money? The more you understand about what you own and why you own it, the more you're able to not only forget about volatility, but shall I say from a common sense standpoint, Matt, perhaps take advantage of volatility, dare I say? Most investors don't do it, though, because they don't know what they own. They don't know why they own it, and they invest in things that are opaque with a hope and a prayer that they're going to turn out okay, right? So let me give you an example. Celgene. Have you ever heard of Celgene?
I actually think you brought it up on a previous podcast, but past that, no, I have no idea what the heck it is.
Yeah, so Celgene's a great example of the volatility, right? Celgene's a big biotech company. I mean, it's got a paltry $60 billion plus market cap right now, right? So this is not a small name. And Celgene went from about, let's call it in October-ish, August, September, that time frame. September was actually at $87 a share. Okay, during the correction in the fourth quarter, the stock went to 62, 61, 59. Actually, got down in the 59s. And this is a company actually we had owned in the past, but the fundamentals had changed, and so we had sold it at a much higher prices, and we had been watching it for the last couple of years. And sure enough, from from $87, $90, $95 a share, actually over $100 earlier in the year. Without fundamentals getting any worse, the stock goes from 95 to 59, 60, without changing fundamentals. So why is that? Well, there's various reasons why that could happen. Could be tax loss selling, could be people selling because they're panicking about their money, or it could just be people not knowing what's going on. They're saying they're throwing the towel in, they're forgetting the whole thing, and they're walking away from investing in general. At $66 a share, we repurchased that stock with a sizable position in our clients' portfolios because at this point, believe it or not, Matt, the long-term fundamentals had actually gotten better. They had improved. So not only did you have improving fundamentals, you had a deceleration in the valuation of the company down to 66. Even after we bought it at 66, 67, and went down to 60 during the rest of the pullback during the last quarter of 2018. On January 2nd, when I woke up to go to work, lo and behold, Bristol Myers bought Celgene for basically about $100, let's call it about, at current prices, $99 a share. It was about $102 a share based on the closing price of Bristol Myers on December 31st. The moral of the story is when you invest in great businesses and you know what you own and you know why you own it, volatility creates the opportunity to buy into a great business on sale or continually buy into a great business on sale. The problem is investors don't have the clarity, they don't have the transparency, and they don't have the flexibility to take advantage of those opportunities. Lastly, as you look now, we're recording this on the 16th of January, right? And as I'm speaking to you, the S&P 500 year to date is up 4.56, and the ACWI is up 4.69. The Russell 2000 is up 7.86, and the NASDAQ is up 6.22 in the first 16 days of 2019. Do you remember me telling you the story, Matt? Investors make the huge mistake at looking at their monthly and quarterly statements therefore looking at their accounts on a daily basis, taking a snapshot in their mind. This is what my money is worth, when the reality is it isn't worth jack squat until you sell the investment, whether it's for a gain or a loss. This is why investors continually miss their goals and miss their investment objectives.
Let's rewind to something that you had explained earlier. And I think this is a very powerful educational point about how you stick to the knitting and what you do. You talked about the flexibility, being able to purchase great businesses when they're on sale. But how do you do that? I mean, most people listening to this podcast are 100% invested in the market, or their financial services professional has cash sitting on the side to take advantage of opportunity. You do things just a little bit differently. How do you figure out how to take advantage of those things when you are invested? Was that a good question?
Yeah, absolutely.
Oh, okay.
Question. It's a great. I understand what you're asking. It's a great question. Bluntly, blatantly, bottom line, it boils down to, I hate to be repetitive, clarity. What do I mean by that? The more you understand about what is in your portfolio, the more you understand the why behind every single position in your portfolio and why you own it, it gives you an additional layer, an additional level, and an additional advantage of clarity to make decisions for your portfolio. So I'll give you a very good example. During this pullback, the Chinese stocks pulled back heavier first. They started pulling back first. They bottomed first in the correction, because the reality is long-term fundamentals haven't changed, right? This is just a correction going on. And by the way, well-needed correction. When you're looking at the different types of businesses you own in your portfolio and the reasons why you own them, remember, Matt, Nepsis is know what you own, but also why you own it. And in each position in our portfolios are owned for a specific reason to accomplish an overall goal. Here's the analogy. I always use this analogy. Think of an automobile. We've all bought cars before, right? And we go to the lot and we look at the beautiful leather seats and we see what kind of stereo system it has, and we look at the beautiful paint and all these different things, right? And all we really care about is when we know the reliability, we know we like the car, it fits our needs, blah, blah, blah. Once we drive it off the lot, we just know that when we press the button or turn the key, the car's going to start, right? But do you know who makes the spark plugs? Do you know who makes the brake pads so when you press the brakes, you know the brakes are going to work? Do you know who makes the air conditioning so on that 105 temperature day out in the sun, when you turn the car on, the air is going to work? Of course you don't. All you care about is that when you press the button, the car works. This is how most people have their portfolios managed and how they let their money be managed. They just think that if I buy this asset allocation strategy from a financial advisor, if I buy this mutual fund, if I buy this ETF, I just know it's going to work. Until it doesn't work, until the correction happens, until my car breaks down and my engine block split because the spark plugs that were in there had a recall, right? That's the premise behind why investors need to know what they own and why they own it. Warren Buffett's talked about this for decades, right? People think volatility is risk. I believe what's more risky than volatility, bluntly, unequivocally, is not knowing what you own. Because when you don't know what you own and or have the ability to know why you own it, I find that to be far more risky than actual short-term volatility. I know that's a lot I just gave you again.
That's okay. I mean, I think that was very clear, and I think you answered my question well, but I want you to dig just a little bit deeper. When you have something in your portfolio that you know what it is and why you own it and what its purpose is in the portfolio, do you usually have positions that you know are your sellable positions to take advantage of volatility?
Without question.
Okay, great. And you know what? I'm not trying to hypersimplify. I know there's levels of complexity here, but
no. I'll give you a great example. Okay, so we owned semiconductor stocks. We owned NVIDIA, Micron, and STM Microelectronics. Okay, these are all stocks we bought in 2015, 2016. These were what I consider to be early stage, early cycle recovery stocks. I know that semiconductor stocks perform best in early cyclical recoveries. Okay. And if you remember, we were on the verge of a recession in late 15, early 16. These stocks were very cheap. We started buying Micron in the 12s. We started buying NVIDIA around 60s, 62. And we started buying STM in the 9s. In October, when the more talk about recession was coming and markets were more volatile, not only had we taken profit along the way owning those stocks because they had performed so well in the portfolios, but we decided to exit all 3 semiconductor stocks in early October. The theory was that whether we're going to, because I didn't know we were going to have a 20% correction. I had no idea. But I also had a situation where I was able to raise cash because we're no longer, one thing our metrics told us, because we do modeling internally, was that the chances of a recession were increasing. They weren't at risky levels yet, but they were increasing. And everybody pretty much knew we were in a mid to late cycle recovery. You always get rid of your chip stocks at that point, okay? Because they're early cycle recovery. Well, I had close to 10% of our clients' portfolios, give or take, in those chip stocks. I raised 10% cash. Additionally, we had another company that had just gotten bought, and we had raised cash on that. And with everything going on, we had 15 to 17% sitting in cash. So the stocks, of course, the semiconductor stocks got hammered. In fact, we actually repurchased NVIDIA at about 135. NVIDIA was the worst performing S&P 500 stock in the fourth quarter. Did I say that volatility is pretty good? It's at 150, by the way, again, right now. Volatility creates opportunity when you know what you own and why you own it. Now, in all fairness, Matt, bluntly, most investors that we manage money for have no idea why they own what they own in their portfolios. They just know what they own, right? Because they can log in and they can see every single position in their portfolio at any time during the day they want. So they know what they own. But they don't know why they own it, because bluntly, that's why they pay us. Mm-hmm. And we do communicate with our clients on a quarterly basis about companies we own. We pick 1 or 2 every quarter. We tell them why we own those particular companies. But at the end of the day, from an investor's perspective, I have found that the emotional predisposition is really focused more, or the importance is focused more on what is owned and not why. Because most people don't care why they own it. They say that's why we pay you.
Well, and I love that, and I agree. But the simple fact you were able to answer that question with that level of clarity would increase my ability to have confidence in you, because that just flat out makes sense. This is so contrarian to what they're hearing all over the place. Buy something, hold it for forever, don't pay any attention to it. You don't need to worry about it. I got it covered. Just ride through the volatility. We're hearing that a lot right now. Just hold on to your, but it's not, they're not saying what you're saying. And I'm very grateful, not only that you blog, but you also have a radio show and you have a podcast, because you're really hitting the big things here to get your message out there. Okay. And with that, we're going to have all sorts of fun this year, talking about some super, super cool things. So I know there's going to be great opportunities. What are your closing thoughts for today's podcast?
Well, I want, one of the things that was unique, and this is, you have to think about investing as a marathon, not a sprint, mm-hmm. right? And everyone wants the quick hit, but investing really is a marathon. When you invest in something, you already know that it's going to take time, right? And so time in investment, not timing an investment. And when you look at what happened in this last quarter, it was an anomaly. We went down 20% basically in the last 3 months of the year. And what a lot of people probably don't realize and think about, and I could show you names specifically where they got hammered in December more and more because people were more than likely tax loss selling. If you don't know why something's being sold and it's being sold, at the end of the day, frankly, you should really assess why it's being sold. And a lot of stocks were being flat out sold basically for tax loss harvesting. And I want to give you one example, and then we can wrap up. There's a company out there called PetIQ. PetIQ is a big, obviously in the name, pet pharmacy, pet food, all that kind of stuff. That stuff isn't going to go away. In fact, pet companies do really well during recessions, right? So this stock back in October was sitting around $35 a share. It had come down from over 40 already, right? But as the year came to a close and the company went closer to the end of the year, people were tax loss selling this thing. And this stock bottomed on the 24th of December at $21.60. That's how much it went down in basically 2 months. By the way, today it hit 30, almost back to where it was 2 months ago. That to me is amazing. Tax loss harvesting is not a change in fundamentals. Flexibility and transparency creates the opportunity to buy those businesses on sale, which of course we bought lots more of that on sale.
Mm-hmm.
So anyway, that's my soapbox for today.
We should probably chat at some point on a further podcast about tax loss harvesting and how that can be an opportunity for somebody who uses your system, because it seems to be rather predictable, isn't it? I mean,
yes,
okay,
very much so.
Okay.
Yeah, it's a huge advantage for investors, but most people aren't aware of it because it's hard to do that with mutual funds and ETFs.
Yeah, absolutely. All right, Mark. Well, hey, you know what? This was super fun. I'm so glad we started off the podcast today with somebody who was really trying to troll you and ended up just flat out proving your point. That really made my day. I had a huge smile on my face when you read that, so I appreciate that.
That was pretty good. Made my Sunday.
If you have not subscribed to the podcast, make sure you click that subscribe now button below. For everybody at Nepsis and for you to invest with clarity, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.